This is the current federal tax developments for the week of October the 20th, 2025. Current federal tax developments are brought to you by your State Society of CPAs. I'm Ed Zollars, and I'm recording this week from Phoenix. I'm going to apologize a little bit for any background noise you might hear. I'm not able to use my regular setup this week, so we got a little bit of things going on the road, moving around, and basically maybe a little noisier here today, but we'll hope for the best. What we have this week, developments, we have the employee retention credit refunds. And the issue here was a bankruptcy case where the technical employer of the parties for which the credit was paid was basically a management firm that was owned by the same people that owned the hotel that was in bankruptcy. And the bankruptcy court had to decide if the ERTC refund that had been paid to the entity outside bankruptcy actually was an asset of the bankrupt entity. We'll next talk about a lawsuit and basically a plaintiff that got upset when she was asked to provide her identification number to the defendant in order for the defendant to pay out what was the agreed upon settlement. And because of that, she attempted to back out of the settlement. We'll talk about the issues that arise in a case like that, how the court resolved it. We're also going to talk about an attempt to put together a not-for-profit, what's called here, which is going to lead to the question of the operational test failure and commercial activities and private benefit in a not-for-profit that kind of got running because it appears somebody got bored during COVID. So that was part of the issue that came up. We also have a taxpayer, this time a tax preparer, that went to court and attempted to challenge the IRS's ability to suspend their e-file privileges, arguing a couple of theories, including an argument that it, basically due process claims, so constitutional claims even. We're going to talk about the taxation of certain investment losses. And the key question here is going to be, it's an international investment, and the question becomes the taxpayer is trying to claim a theft loss on having been deceived. And the issue we're going to look at is the basic problem we have under 165 for thefts, in that you have to show it as a theft loss under local law. And we'll discover that the court have held the taxpayer failed to do that. And finally, we're going to go through a case of a collection due process issue where the tax court agreed with much of what the IRS decided in the collection due process appeal, but they didn't agree that the taxpayer had never requested the consideration of an installment agreement. So we have a little discussion there, and for that reason, you'll find out that that part's going back to the IRS for full consideration and working up that issue. So let's talk about that ERTC credit and bankruptcy. This is the case of Stephen F. Gray versus the Williamsburg Hotel bankrupt, BK LLC, and Tony Moskovitz and Michael Liechtenstein, who are in the adversary proceeding. Case number 2207049, the United States Bankruptcy Court for the Southern District of New York. The opinion was released on October the 10th. Now, the key issue here is who owned these ERTC refunds. Are these refunds claimed and received by a non-debtor manager? Did that constitute property of the debtor's estate in this fact pattern in bankruptcy? And did that require the managers to turn the funds back over to the bankruptcy estate? Now, obviously, as I noted, we're going to find we have our same owners in both cases, ultimate control of the individuals. So obviously, the individuals would prefer it stayed with the managers. We'll talk about that. Now, in this case, the debtor, which was the hotel owner, 96 Wythe Acquisition LLC, and the manager, Williamsburg Hotel BK LLC, were both controlled by the same individuals, as I said. Now, remember, the hotel's in bankruptcy, but the management company is not. So the management had used the debtor's hotel's revenues, cash flows, and funds to satisfy all payroll obligation, including unemployment taxes for the hotel's employees. Now, the hotel, was not considered the employer as far as the IRS was concerned. The management company filed the 941. The W-2s were in the name of the management company. And therefore, when the manager claimed the $2.3 million in employee retention tax credit refunds following the enactment of the CARES Act, the question becomes quickly, is that the management company's refund? Now, the court looked at the relationship between the party, and there was a December agreement in 2017. And that provided the management's compensation was going to be 3% of the gross rent collected and no real interest in anything else. Now, the management company acknowledged that all rents and revenues generated by the hotel were the sole property of the hotel. They came into the management company's control to, pay the salaries, etc. Now, the court found that since these taxes generating the ERTC refunds were paid exclusively from the debtor, the hotel, the company in bankruptcy's revenue, that the refunds themselves are property of the debtor's estate under Title 11 of the United States Code, Section 541A, Title 11 being the Bankruptcy Code. Okay. Now, the reason for this is bankruptcy estate property under Title 11, United States Code 541A, is broadly defined to include all legal or equitable interest of the debtor in property, including proceeds or profits from the property of the estate. And under Title 11, United States Code Section 542A, the trustee took an action here to seek turnover of the refunds that were currently being held by the non-debtor party, but that the bankruptcy trustee said this is property of the bankruptcy estate. Now, under the Internal Revenue Code, Section 6402A, that mandates that refunds be made to the person who made the overpayment. In this case, that was the manager. The management company was the employer. They filed the 941s. The refund check went to them. Obviously, they want to keep it, right? But the court found that the specifics of the tax refund law, the fact that under the Internal Revenue Code, that check is going to go to the manager, do not bar the trustee in the bankruptcy case from asserting they have a superior claim in bankruptcy, and they have a right to get that money from the management. The crucial issue that has to be decided is the source of the funds used for the payment. And that came clearly from the revenue of the bankrupt party, the hotel in this case. Okay. Now, the trustee also argued that the defendants were simply unjustly enriched. I mean, they basically were an agent there shifting property around. This is unjust enrichment. And the bankruptcy court, in this case, for unjust enrichment, looks under governing state law, in this case, New York law. And that law would have found the defendants met the requirements of being enriched at the bankruptcy estate's expense, and equity would require restoring those funds back to the bankruptcy estate. And by retaining and distributing those refunds, which over $500,000 were paid personally to the owners at this point, the manager engaged in impermissible self-help under the bankruptcy law, right? So the manager effectively paid itself outside the priority scheme, right? There's a priority for who gets paid in bankruptcy, and the manager was there. The manager said, well, we're owed money for managing, and so we're just going to keep this. And the court said, nope, sorry. It's going to go into the bankruptcy estate, who will then determine who gets paid out of that. You don't just get to keep it. It's not the case. The old line that possession's 9/10 of the law isn't going to work here. You have to give those funds back to the bankruptcy estate. And of course, most likely they're not seeing those funds back because, creditors, etc., will probably step in ahead. So in this case, the court granted summary judgment to the trustee, then said that, the managers have to turn over the remaining refund and account for any amounts that have been dispersed. They're going to go recover those, obviously, from the managers individually. So that's going to be part of the great fun game. Next up is something we see all the time. We're going to talk about a lawsuit settlement enforcement and the fact that the party, after signing for the agreement, discovered that there would be a 1099 issued, and now she objects to it. So this is a case of Barbara Romaine versus Gregoire Motors, Inc., case number 17CV7251, the United States District Court for the Eastern District of New York, and this one came out on October the 14th, 2025. So the key question here, we have settlement tax law disclosure. It's a lawsuit settlement. What happens when the intent collides with federal law for tax reporting? So the key issue was, can she withdraw from her written settlement agreement shortly after signing, claiming a lack of mutual assent because she expected no Form 1099 would be issued, right? The background of this was there was litigation over an auto lease. It involved her, the car dealer, and in this case, I forget the car company right now, but it was basically, the manufacturer was involved as well. She had claimed that she had asked for a 2-year lease and that at some point they had effectively substituted a 3-year lease in. Obviously, she defaulted on it, and she was suing them then for damages at that point. Now, they had negotiated finally. They'd said, okay, we're going to pay over between the car dealer and the manufacturer. We're going to pay you $30,500, right, to settle your claim against us. However, 6 hours after signing, she received an email that was requesting information necessary for the defendants, in this case, the manufacturer was the one reaching out initially, to file a Form 1099 reporting this settlement proceeds. And she's like, I never agreed you could tell the IRS. That was it. So there wasn't mutual assent. Now, her argument was that tax law implication, the fact that 1099 be issued, was a material term that was misrepresented or lacked mutual intent, right? Or, mutual assent. They hadn't both agreed to that point. And even though she had signed the document, now at the time she discovered this, she had signed it, but the countersigned copy hadn't yet come back. So basically, the defendants hadn't yet signed it. The question we're going to have is, can defendants force her to go forward with the settlement, or do we reopen everything again and, we're going to go back and renegotiate the deal? Now, bottom line here is, it's key to remember under the Internal Revenue Code of Section 6041 and the Treasury Reg 1.6041-1F, companies must issue a Form 1099 for every settlement payment exceeding $600 that they make. That is a mandatory disclosure. It does not determine the taxability of the item. Now, obviously, if you just want to kind of, play, well, if the IRS doesn't know it was paid, then I'm just not going to report it. Yeah, you're less likely to find the IRS ever going to raise the question whether it's taxable. But the fact that you really have no option, but that 1099's got to come out. The court pointed out, you cannot negotiate the taxability of a settlement. Okay, basically, you cannot dictate the correct tax law statement. Now, that's probably not totally correct the way the court did it, and I won't say totally correct. It's correct as stated. The payment for what she said, gang, yeah, it's going to be a taxable payment, most likely, except to the extent that she was actually out of pocket for anything. But, there is a chance when you're negotiating a settlement and there are taxable and non-taxable damages that are being argued for. Yeah, if you settle primarily on the not to be paid for the non-taxable items, that's something is part of negotiation and the terms and making sure it's written properly so that it's clear that this payment is for the things that are not subject to tax. Oftentimes injuries under Section 104, physical injuries. Going to be tough to see how that works here, but still there. But ultimately, they are correct. Having decided she's going to be paid $30,500, for basically having been, her claim was she was deceived into signing this 3-year lease when she only wanted a 2-year lease. That's not something that automatically is non-taxable, and it's reported. That's how it has to go. And the court held because the law dictated the reporting requirement, the tax law treatment of the settlement could not have been a negotiating term during the mediation. You cannot say, and there are clients, and there are even attorneys, non-tax attorneys, who seem to think you could just mandate the other side not issue a 1099. No, can't do that. That doesn't work, right? Settlement agreements are governed by New York contract law, right? They require mutual assent on all essential terms. So that's the test she's saying. It wasn't involved here. Well, the court applied a case called Winston, which in New York State determined the intent to be bound to a preliminary agreement. Now, factor number one, did she reserve rights? that favored enforcement. She provided no evidence that she reserved the right to withdraw her agreement when she signed. When she signed on and said, yep, I accept this. Remember, the assertion is against her right now, right? The other party has a signed agreement. Yes, they haven't countersigned it yet, but they have a signed agreement. Generally, when it goes to you, signed by the other party, you sign it, it's valid. She hadn't told them that she reserved the right to withdraw that up until the time they'd signed it or anything of that term. The agreement on terms, that favored enforcement. Tax disclosure was not an essential negotiable term left open. This claimed to be a settlement solving the whole problem. It said nothing about taxes. That wasn't even a term left open, so it's not the case there. And it was reduced to writing. That favored enforcement. Physical signing by her provided strong evidence that the agreement was final and binding, that she had agreed to this. And the real question is, has she agreed to it? Right? The other party still had to sign, but obviously they're willing to sign. The question is, can they force her to follow this agreement? Right? So basically, in this case, the court recommended granting the motion to enforce a settlement. Her desire to avoid mandatory tax forms, which was not expressed during negotiation, doesn't void a binding settlement. What she's asking to do, this settlement was to be the whole thing. That being said, right, the tax issues would fall where they may. The fact she might not have been aware of the tax issues, or she might not have asked anybody about them, isn't really relevant. The fact is, it had to get a 1099. So, key issue, if you're advising a client on a settlement, make sure that you clarify the payor has got to report 1099s on almost all occasions for settlement. That's a separate form. You are required to provide your ID number for them to do the 1099. It does not itself determine the tax benefits. Obviously, as I said, and I know what she's thinking, it's on a 1099. The IRS is therefore going to come after me. Yeah. And it's probably taxable, I hate to say. So it probably means she's going to pay tax. But you can't say, well, I'm only signing this agreement if you, decide not to pay tax or decide not to report it. As the court noted, that would be an agreement against public policy. And at that point, the IRS could seriously go against the issuing company and, assuming that she was aware it was properly taxable, they could even, go for her for trying to evade taxes by trying to ensure it was never reported to the IRS. So, you got to be careful there. Let's go to the world of 501c3 not-for-profits. And we're talking about operational tax test failure. This is something we've seen. This though is going to look at commercial activities and private benefit. This is Coaches 101, a New Jersey nonprofit versus Commissioner Tax Amendment Decision 2025-106. This came out on tax filing day, October 15th. Okay. So this was a denial by the IRS of 501c3, charitable entity who could take charitable contributions, deductible charitable contributions from other parties, status for this organization. So the key question was, did this organization qualify for tax-exempt status under Section 501c3? Was Coaches 101 a proper tax-exempt org? Now, to be a 501c3 organization, and unless you're a church, you have to apply for the IRS to approve that status. And even a church still has to meet this test. They just don't have to demonstrate it up front. That organization must be organized and operate exclusively for exempt purposes. The limited purposes found in 501, about the sorts of things that a organization that's going to be a C3 organization must be doing. If there is a single substantial non-exempt purpose, it is fatal to 501c3 status. Okay. And in this case, the IRS cited substantial commercial activities and the, basically private inurement, private benefit rules. Now, this is always an interesting line because we know there are, the unrelated business income tax issues that could apply to 501c3, which they can. And obviously, it's unrelated to their exempt activities. The catch is just having unrelated business income does not blow your C3 status. However, if you are primarily, or it's substantial, there is a big, this is not just kind of an off to the side minor thing, but this is a big thing that's going to blow it. And in this case, coaches 101, yeah, it was pretty much the non-exempt stuff was the primary reason, with a little bit of window dressing, to have some of the earnings end up going to the charitable purposes, right? So the court said it failed the primary activity prong of the operational test. They said, given the facts of the case, and the case was a bit messy because he represented himself, so the guy who founded it, but it appeared to be operating a commercial business to produce profits. And their evidence of commercial was it was meant to sell tickets to live events, option contracts, books, CDs, and advertising, founder designed shoes for $189 a pair. It was basically, with his intellectual property that he was being get. And the organization's main goal was documented as raising close to $1 million selling products and creating a social media empire through media production and sales, which would primarily promote this guy's intellectual property. Right? Now, also, there's a second failure of private annulment, which was huge here. Right? If the net earnings inure in whole or in part to the benefit of private individuals such as the creator or their family. Now, this organization was structured to act as a literary agency for the founder, Omar. Okay. Omar's literary agent. The proceeds from his works were paid back to him as wages or royalties from the charity. And the organization promoted his IP, the fictional character Mad Comedian, right? And some of the red flags was the organization included a profit-sharing plan and reported paying the founder $17,831 student loan cancellation as miscellaneous income. It was his pocketbook. He decided how much money went to him, right? And then had some go over to the charity, right? The structure mirrored the private benefit that is explicitly forbidden by the regulations. Those proceeds were flowing directly or indirectly to him from the activities of the not-for-profit. They were basically his income, right? And he admitted that the profit-sharing plan was an attempt to circumvent the tax code on personal benefits, to pay him what he couldn't otherwise get from the charity. Representing yourself is amazingly effective. Sometimes, yeah. That, by the way, is a little bit sarcastic. The tax court sustained the adverse determination, confirming that the pervasive commercial nature and activities and substantial private inurement, most things were going to him. Yeah, it wasn't a 501c3. At best, it was his own, Schedule C, should have been. And then, he could, of course, make charitable contributions from those earnings. But yeah, it doesn't work this way. Yeah, that's not exactly how it's going to work. And obviously, as noted, the organization was knocked down. He's now got to deal with that. Now we're going to go to the case of the Zurin Tax Company, Inc. versus United States, case number 24 CV 01511. Again, Eastern District of New York, United States District Court. This week had a lot of New York activity in the cases. October 15th of 2025. This is can the IRS, how much discretion does the IRS have to suspend your e-file abilities? Okay. Now, in this case, a tax preparer challenged the IRS suspension and the expulsion of his firm from the e-file program. They sought injunctive relief and they claimed violation of due process under the Fifth Amendment and the Administrative Procedures Act, the APA. Now, the IRS basis for suspending him probably won't shock you that he got suspended. There was a criminal investigation that determined that fraudulent returns had been filed utilizing his eFIN. He was doing that. That's a problem, right? You're going to be suspended. Now, the preparers said, ignore that, right? There is a protected property interest in the eFINs and the ability to e-file, and they argued this function as a de facto business license, and that by doing that, they were just going to take him out of business before he had the right to challenge it. right? That'd be the activity, a proper right to full due process. Now, the court took a look at, okay, there's this concept of thing called a protected interest. A constitutionally protected property interest requires a legitimate claim of entitlement, meaning that the issuing authority's discretion must be so narrowly circumscribed, I should say, not circumcised, get that right out, that the approval is virtually assured. Right. It's a mere, rubber stamp approval. The question is all you had to do is pay the right fees, answer the right questions, and basically give the right information, and it'd be approved. Now, the IRS guidance in publication 3112 and in Revenue Procedure 2007-40 govern the e-file program. And publication 3112 lists non-exhaustive denial factors, including disreputable conduct or being the subject of an active IRS criminal investigation. Now, the court found that the IRS is charged to assess preparers, suitability. That requires the exercise of judgment, reason, discretion. Therefore, there cannot be a virtually assured entitlement of everybody to get this license. It's not like getting, like here in Arizona, let's say, a license, a transaction privilege tax license, so you can sell product. That's pretty much going to fall into this protected category. You pay the fee, you get the license, right? That's going to be that kind of background. Now, the preparer argued that the e-filing mandate, though, changed all of this. That's found in the Internal Revenue Code, Section 6011E3. That created the protected interests, right? Now, the court rejected that. They said, look, the fact a license might be necessary to operate a business does not create a protected interest. Protection only arises if the issuing agency has no discretion in issuing that license. And you kind of think about that, I do, in terms of like the CPA license, especially in states where only CPAs can audit financial statements. Yeah, it requires you to be a CPA, right? The license is required. And if you're an auditor and you don't have a CPA license, you're kind of in trouble, right? You're not going to be able to do that work. Okay, fine. So the question then becomes, well, do you have the authority to issue the license? But they do, right? You got to pass the exam. You've got to pass a background test. You have to do those other things, right? The fact that you have to have that license to do audits does not override and say, oh, it's irrelevant that, the state board, is supposed to check all these rules. They're not allowed to do that and deny you the license because you wouldn't be able to be an auditor anymore. That's kind of the point. So the occupational liberty claim was denied. They said, look, even if that was true, that you could do that, you still can prepare returns by mail, right? Obviously, all of your clients would have to request that from you. And it's going to really slow down their refunds and probably going to make it that nobody wants to come to you, because most often why you're going to find a preparer had some fraudulent returns was they were promising big refunds and in your bank account right away. And obviously that's not going to happen, right, on a paper filing. Now, they did have a second argument away from the Constitution one, which is that their actions violated the Administrative Procedures Act. Again, I mentioned last week, this is something we're going to see time and time again now because it became effective in challenging regulations. The problem is we keep seeing it being raised outside the regulatory context, right, in issuing regulations. Now, they argued, the taxpayer argued that the sanctions notice was wholly inadequate to allow for a meaningful administrative appeal. Now, the court found that, the firm failed to cite any specific IRS rule or regulation prescribing the required level of detail or particularity for a sanction notice under the e-file program. And the court's not going to impose procedure requirements on the agency unless the law mandates them, which it doesn't here. So basically, it's there. The complaint was therefore dismissed because they lacked a protected property interest for the due process claim, and they failed to demonstrate the IRS violated any specific rule under the Administrative Procedures Act claim. So, yeah, they're not going to be able to e-file returns. It is probably going to be a bad thing for their business. Of course, being under criminal investigation eventually can kind of become a bad thing. Your clients want to know why they're meeting you in prison. In the worst case scenario, it's like that's usually a little tough to explain. But yeah, they're not going to be able to keep moving forward on that issue. Now we go to a theft loss case. This is Potts versus Commissioner, Tax Memorandum Decision 2025-108. Decision came down October 16th. And this is an investment that somebody made, significant investment. And their claim is that they were misled, right? And they're trying to get this as a theft loss. Why would you want it as a theft loss? Remember, if it's just a bad investment, right? We put in over $2 million and essentially, we're never going to see that money again. That would be a capital loss, which often is, unless you have a $2 million capital gain to go with it, that may not be very useful. And that capital gain would have been taxed at lower rates, long-term capital gain at least. So it's like, if you get it as a theft loss on a transaction related to a profit-making activity, which investing is, under 165, you are allowed to claim that deduction, even if it's not for a trade or business. Yeah, that type of theft loss. Now, if somebody just breaks in and steals your television, tough loss. That's barred by the Tax Cuts and Jobs Act and now by the basically OB3 that disallows personal casualty losses. But this one would be deductible. So that's why they're trying to argue the theft loss. And they claimed it, right? They claimed the funds were misappropriated by the sellers of an international gaming shares that's in the Kirks and Caicos. Okay. They basically remind that. They said those funds were allegedly diverted instead of being used to inject capital into the company for a casino project that they had been promised orally when they had bought those shares from the other party. Now, the IRS reviewed the return after it was filed, and they assessed a $431,691 deficiency and an accuracy-related penalty, 20% accuracy-related penalty for substantial understatement of income, of taxes, of $86,338. Taxpayer filed the tax court to challenge that IRS position, right? So let's talk about what is a theft. Under Section 165, you have to prove by a preponderance of evidence that an actual theft occurred under the law of the relevant jurisdiction. In this case, the purchase had been made in the Turks and Caicos. You have to look at the Turks and Caicos theft ordinances or similar ordinances that are of a theft type to see if it qualifies. So here's the catch. The taxpayers lived in Arizona, but we're not going to look at Arizona's theft law. We're looking at the law of the entity that would have jurisdiction over this purchase, over this transaction, which would be the Turks and Caicos, right? Now, their theft, which really isn't that different from most of the U.S. states either, and get to it, it is appropriation of property belonging to another through dishonesty or deception and with the intent to permanently deprive. Here's the catch. The property, the money went to these guys. The property was was essentially the stock they received. They received stock in that company. There's no question. Right? Real stock. Now, they claim there was an oral promise that the seller was going to put that money back in the company and, use it for casino work. And they claim that never happened. But here's the problem. They got the property they bought. Now, let's be honest, you probably should have insisted. Hey, I think the smarter thing probably would have been to have bought stock directly from the company, right? In which case, then you still got the stock. I mean, your case is buying the stock. At the very least, you're now saying that you were told it was going to be used for that, but yeah, that becomes now kind of a he said, she said problem, right? So they purchased, and the other problem is existing shares from VT Enterprises, the seller, rather than making a capital contribution to Carib Gaming. They were told by the seller, they claimed that money, and they probably were told that money would go into Carib Gaming and be used, to help in operations. Once the sales was completed, that $2.5 million belonged to VT Enterprises, right? Because those funds belong to VT Enterprises, they failed to establish the $2 million belonged to them or Carib Gaming when it was allegedly taken by, VT Enterprises and used for other purposes. Any subsequent theft of the funds was of funds belonging to VT Enterprises. They received exactly what they contracted for, and any loss would be recognized on disposition of the shares, a worthless security under 165G, which again is a capital loss, not a theft loss, not an ordinary loss, and not available till you can show that these shares are worthless, not just that they didn't, use the funds for the right thing. Okay. Now, what about deception regarding intent? Now, the Turks and Caicos law defines deception to include misrepresentation as to present intention. Now, they said, and the key word here is going to be present. What are their present intentions? They relied on alleged promises concerning future intentions, promise to reinvest and complete the project. That was the promise made when they bought the shares. The court declined to expand the definition of deception to accommodate these future intents. It wasn't present. That was to happen in the future, right? Especially when the purchase agreement superseded all oral arguments. It stated that in the agreement. That's bad. It said this superseded all oral agreements, and it said nothing about using any funds or putting these funds into Carib Gaming or, using those funds to essentially, improve the casino. None of that happened, right? Now, so they said, you owe the tax. What about the penalty? Now, the resulting underpayment was substantial, greater than 10% of tax required. Now, they claimed they relied on their CPA firm, a national firm, who prepared and signed their return. But the problem is, if you're going to claim that as a taxpayer, you need to show that other party gave you an opinion. Show me the opinion, right, that they gave you on entitlement to theft deduction. And basically that you asked them to opine on it, right? And you provided all necessary and accurate information to the advisor. They couldn't show either of those. Generally, there's also two other requirements. Number one, you have to have had, it had to be reasonable for you based on your knowledge level and what you know, to have assumed that the party you asked had expertise to make this call. And you also have to show that you had no reason to doubt the answer they gave you. But the problem here is they just asked the firm to prepare the return. They were claiming this $2 million loss on the return, but they just asked the firm to prepare it. As a practical matter, that's not going to get you out of penalties. Now, I will add one comment here that I'll make, which is, as somebody who is preparing returns, be aware of one problem here for you potentially. The argument is going to be that, well, you should, first thing is under the standards for, let's say, either the SSTSs for CPAs or Circular 230 effectively for EAs probably. And I say probably because, we've got a whole the status of the rules in the Circular 230 regarding preparation of returns and whether they are valid or not. Probably not against CPAs, but probably against EAs as level of authority the law grants. But in any event, identical standards exist under the SSTSs for CPAs, so it's not really much of a win, CPAs, to not have this issue. You do have to inform clients about steps they could take to reduce their exposure to penalties. And under the pay, prepare, penalty provision, you have a rule that you're liable, you're potentially liable for penalties if a understatement results from return and the position did not have at least substantial authority, and you didn't advise the client, you basically didn't have disclosure on the return you signed. That I definitely could see a plaintiff's attorneys attempting to, use. That's going to be your problem, to try to get you to pay it. So they can't get out of it by saying that you did the return. But because, the law there is very clear about what's considered to be reliance, they are supposed to, they're responsible for their return. And if they have something, that they don't, they don't believe they know if it's true or not, deductible or not, they should ask for an opinion. Yeah, that the problem there is you're still likely to find that somebody could very well try a claim against you. So be aware and be concerned in that case. But if you want the clients to be able to use your stuff, then they need to get a formal opinion from you. And the other thing I tell them is to look, here's the catch. Remember that little part about you can't have reason to believe the advice is wrong that you're claiming to rely on? That also means that the other issue is when I tell you the answer, if you don't like it and you go get somebody else to give you the answer you like, the problem you're going to have, the IRS in discovery discovers the fact you started with us, and discovers the fact that we told you that we didn't think it was deductible. Now your problem's going to be a bit different. What your problem's going to be in that case is that, you were told by a pro this wasn't deductible. Yes, you were told by another pro it was, but you can't just say, I have no idea how to choose. How would I know which one's right? Well, the problem is you clearly had come to the conclusion you're just going to keep asking until somebody told you what you wanted to hear. And so what I tell them is, you go to somebody else. I could be wrong. You go to somebody else. But if you follow them, they darn well better be right. Because if it turns out the court rules against you, you're probably getting penalized because now the fact that you were told by one party you couldn't take it, and then you went somebody else, they said you could, and then it turns out you couldn't. Again, you appear to be opinion shopping. That's not good faith because reasonable cause only works if it's good faith. So that's the background. So in this case, both the disallowance of deduction was sustained. They didn't prove a theft, and they didn't show an accuracy-related penalty. If you ever have a client trying to claim a theft for something like this, you need to get an expert in the criminal law for the jurisdiction in question that would have, that would be able to make the charges under this particular theft, assuming it was a theft. And you have to determine if that theft is a theft under state law. It does not mean state, or in this case, Turks and Caicos law. You don't need to show it was ever prosecuted. You just need to show that it could be prosecuted, that it would be a crime. That'd be your key. Next up, collection due process issue. Avalon Home Health versus Commissioner, Memorandum Decision 2025-107, I should say, from October 16th. Now, this case was a levy and collection due process issue. The taxpayer challenged an IRS notice sustaining a proposed levy for its 2014 income tax liability, asserting dispute over the underlying liability and seeking an installment agreement. Now, we're going to discover they're going to lose the first one. They're going to, however, get it sent back to the IRS for consideration of the second. Now, under the judicial standard, when the underlying liability is precluded, basically they review the Court of Appeals determination, or they review the appeals determination for abuse of discretion. And what the IRS has to do is they have to verify the Apple law and procedure, consider relevant issues like collection alternatives, and balance efficient collection with the least intrusive action. And remember, an abuse of discretion level is you got a pretty high hurdle to clear, right? You got to show the IRS abused their discretion, not just that the court might have come to a different decision. That you'll find when we talk about cases and where the court's reviewing. In certain cases, courts can review things in what's called a de novo method, where they just simply start from scratch, as opposed to this higher standard where the taxpayer is going to have to show much more, where we're just looking to, did the IRS in their administrative proceeding abuse their discretion? Okay. Now, what about, again, but if the underlying liability is in question, then the court does kind of go de novo. So the taxpayer attempted to challenge the 2014 liability because notice deficiency was returned as undeliverable. Okay. Now, generally in a CDP, you can't challenge liability unless you didn't have a prior opportunity to challenge it. So they're arguing, our notice of deficiency was returned undeliverable. We never saw it. Now, the court found the taxpayer was precluded from challenging liability because a subsequent notice of federal tax lien, letter 3172, provided a prior opportunity for an appeals conference, which they didn't go for, right? Now, what did appeals do therefore? So saying, look, the liability is there, it's fixed, you lost your chance to challenge it. The only option is to pay the tax, sue in district court. Okay, what about the actual amount they're trying to collect on the liens and other amounts on there? they did find one problem, which basically appeals did fix. They found that or I should say, not really a problem. This is right. Okay. They discovered the proper managerial approval was not obtained in advance of the assessment for the accuracy related penalty under 6062. Because of that failure, they said the penalty is abated in full. The IRS doesn't do that properly. They can't collect the penalty. So the penalty is not part of what we're going to try to collect from you. That's gone entirely, right? Now, the taxpayer filed a CDP request seeking an installment agreement and began making voluntary monthly payments toward liability. Okay. Now, the appeals determination sustained the levy based on the claim that the petitioner had rejected an installment agreement. They said, look, we don't buy the taxpayer's theory that this was like a kind of informal installment agreement for voluntary payment methods was already in place. The IRS had to follow. What they did say was, but when you rejected it because they didn't file, they didn't do the formal process, they just need to raise the option as an alternative in the collection due process. They don't need to actually have executed an installment agreement already. The fact you tell us that isn't one actually is kind of, proof that the issue is still out there, right? They said there is no support for the assertion that the taxpayer rejected the installment agreement. What they said was the denial was rejected as what the court found, this is not good, a post hoc rationalization for their action. They had already decided to disallow everything, and then they realized, oh, yeah, there was this thing. So then they tried to come up with the reasons, but there's nothing in the administrative record to back what they're talking about. So, since they didn't properly review the collection alternative, the court could not conclude the balancing analysis was not an abuse of discretion. Balancing collections, is it better to go, we're going to look at the balancing, which is better for the government, allowing them to have this installment agreement or going for more draconian assessment options. Court can't review that because you never truly considered which was better. IRS, go back and do that. Okay. Now, what it did confirm, though, you do not have an installment agreement until you have a written agreement. Under 6159A, voluntary payments do not create an informal installment agreement binding on the IRS. And that can be a problem because a lot of people who owe the IRS money, we know how the IRS is kind of inconsistent in how quickly they go after enforcement. They may say, well, I've been paying this way for the past 3 years. And no, I never got a formal agreement, but the IRS hasn't done anything. So really, haven't they adopted it? Nope, they haven't. It's got to be in writing to be enforceable. However, they denied the IRS's motion regarding the 2014 liability and sent the matter back to appeals. Appeals has got to consider, the collection alternatives because they rejected an obvious installment agreement option. They have to consider that. And, does the taxpayer, are they willing to accept an installment agreement that's in line with the requirements? That was never actually understood. So this is critical, right? That appeals must document substantiate consideration of collection alternatives in order to avoid a remand. And it makes it very clear that you only have an installment agreement once you have the official one in writing that meets the requirements under 6159A. Well, this has been the Current Federal Tax Developments for October 20th, 2025. As always, it's brought to you by your state society of CPAs. If you have any questions, you can email me at zollars@currentfederaltaxdevelopments.com. I also am present on the Connect sites for Arizona, New Jersey, Minnesota, Illinois, and Washington and Idaho. So I take a look there. If somebody posts, I'll try to see if there's something I might be able to help with and follow up. Otherwise, we will see you back here next week when we probably will have a few more things going on. Developments are getting a little more interesting because the government shut down. Remember, we had that big rush that came right after it because they were getting everything ready to go out. And while they're still working on items for the, OB3 issues and supposedly for the upcoming tax season, even though nobody's getting paid, the reality is, or I guess, well, maybe some are getting paid under that rule. It's a little weird how it's worded. But they're still down to about half the staff they had after the reductions earlier this year, right? So not half the staff they had to begin the year, down to half the staff after taking a 20% cut. which a lot of that took effect right on the same day as as basically the shutdown took place. So, we're looking at a much smaller IRS. And so I do not expect, we've not seen private letter rulings come out since that came through, and I don't think we will. Private letter rulings are similar items, and the tax court is canceling hearings now. That'll have an effect further down the line because obviously, they don't issue opinions right after generally the hearing. But certain things will begin to slow down. So we'll have to see what happens there. But otherwise, we'll see what comes out. It may be a few things like this where we have these kind of tangentially related to tax items to discuss. But whatever it is, we'll see about talking about that next week on current federal tax developments.